Hello. In this video, we'll consider the introduction to deductions. Now, before we get into the introduction to deductions, let's consider the tax formula. So the tax formula starts by calculating gross income, where we have to determine what gross income is, minus deductions. Now, specifically, we're going to see different characteristics of deductions. We first have to subtract away above the line deductions. Above the line deductions. When we take gross income and subtract away above the line deductions, we get adjusted gross income. Adjusted gross income. And this is an important number because many of the other types of deductions that we'll discuss are limited by adjusted gross income, sometimes also known as AGI. From AGI, we subtract the greater of two things. The greater of the standard deduction or below the line deductions, also known as itemized deductions. So below the line deductions. Now, if we're also looking at an individual taxpayer, we also subtract away personal exemptions. Now, there can be many personal exemptions depending on how many dependents are part of the taxpayer's grouping. Now, when you subtract away all these things, you get taxable income. Taxable income, which we use taxable income to calculate the tax liability after we subtract away any credits, and then we compute using the progressive structure rate. Now, I want to key in on two things: above the line deductions and below the line deductions. You notice that both of these have the phrase deductions. All right. So again, this is the introduction to deductions, and it's important to understand this formula because this is really the basis of all income tax with respect to the federal income tax system in the United States. Now, I want to also note that the standard deduction, I'll put a little asterisk there, and personal exemptions, these only apply to individuals. So I'll just put a little asterisk, only to individuals. Only individuals can get these. So the same formula applies for any type of taxpayer, whether it's a corporation, business, or an actual individual taxpayer, or a trust. But the only ones that get the standard deduction or the personal exemption are the individuals. That's important to understand. So I want to talk about some themes. I want to talk about some themes with respect to deductions. And again, the reason we start with this formula here is because some of the themes are going to be discussed. Some of the themes that we discuss, it's important to understand, to remember this formula. So the first theme I want to talk about, above the line, so we'll call it ABT, ATL deductions versus below the line, also known as itemized, below the line deductions. So which one is generally better? Above the line deductions almost always are better for a taxpayer. So if you have the option of getting an above the line deduction or below the line deduction, you want the above the line deduction. And there's a few reasons why. First, just looking at this formula, you can see one reason. Above the line deductions come from gross income, but the standard deduction is not a function with respect to above the line deductions. So you might only have $1,000 of below the line deductions, itemized deductions, but your standard deduction might be $6,000, $7,000 depending on the year. Again, it's inflation adjusted, depending on the amount, and you don't get to actually utilize that $1,000 because you picked the greater of those two numbers, the standard or below the line. Now, the standard deduction, the idea there is that Congress understands that taxpayers are generally, they have some deductions that, again, this is an issue with respect to individual taxpayers, that individual taxpayers, they're going to have general deductions every year that they just should take it into account. And that's why the standard deduction is provided. So it doesn't make it too difficult to calculate. So that's one aspect of why above the line deductions are better than below the line, because again, you don't have that standard deduction issue with the above the line. The second is that below the line deductions are very limited. Lots of them are functions of AGI, and there's even percentages that you can take. For example, charitable deductions are limited to a percentage. You just don't get every single dollar that you give. That's not how it works. You get a percentage. That's considered what you can actually take. And they are limited to adjusted gross income and whatnot. So that's one theme I want to discuss. The next theme I want to talk about is the idea that income is generally viewed as broad, but deductions are viewed as narrow. And this actually comes from an early case, an early Supreme Court case. So this has been a common law, a tax common law, a tax jurisprudence principle that has been around for a long time. And the name of the case is New Colonial Ice. New Colonial Ice. And in New Colonial Ice, again, the U.S. Supreme Court, Justice Cardozo, very well-known jurist, judge, said that deductions are matters of legislative grace that need to be interpreted narrowly, versus income needs to be determined broadly. The idea is that if there is some type of inflow, and it's very hard, or it's very subjective with respect to the rules, like, okay, Bitcoin mining, for example. Well, the rules weren't laid out to specifically say, okay, Bitcoin mining is definitely gross income. No, the principles are they're more subjective in that they're broader. They're not as rigid. Deductions are going to have the same thing, but when you have income, the standards are to be interpreted broadly, but deductions they're to be interpreted narrowly. So the idea is that it almost goes in favor of the IRS almost always. So always keep that in mind. If you're having trouble understanding, it's good to err on the side of narrow for deduction and broad for income. So the next thing I want to consider, categories of income. This is very important. Categories of income. So there's three categories of income and deductions. Categories of income and deductions. The first is business. Next is investment. Investment. And finally, the third and the last is personal. Now, the first two, the tax code calls profit or gain seeking. So we'll just say profit seeking. So if you ever see the phrase profit or gain seeking, it's referring to business or investment activity. Personal is by itself. Now, generally speaking, when you're dealing with deductions, you prefer to be in business, then investment, and then personal. Why? Because business has the least amount of limitations with respect to deductions. So it's easier to deduct something, whether it's actually to deduct it, and we call that allowed. So with respect to deductions, the jargon, the vocabulary with respect to tax for deductions, allowed versus allowable. Allowed versus disallowed. Allowable is another concept. Disallowed. So if a deduction can be taken, it's called allowed. If it cannot be taken, it's disallowed. So with respect to deductions, we prefer to get business first because it's going to be easier for deduction to be allowed. And again, the amount won't be as limited. Investment is next if you can't get business. And then personal in nature is last. Generally speaking, business and investment deductions can be deducted. They are allowed. Personal, though, the general rule is that they're not allowed unless some provision in the Internal Revenue Code allows for that. Some examples of personal deductions that are allowed to be taken include mortgage interest, charitable contributions, those kinds of things that deal with personal activity. In later videos, we'll get into actually distinguishing business versus investment versus personal. So another theme I want to discuss, time value of money, TVM. So this is the fourth theme. Time value of money. The idea of time value of money is that with respect to income, taxpayers generally prefer to defer income as long as possible, unless they know that tax rates are going to change in the future, in the near future, and that they want to, maybe the tax rates are going to go up, so they want to recognize income as soon as possible. Well, taxpayers, generally speaking, prefer to defer income recognition for as long as possible and prefer to accelerate deductions as quickly as possible. So with respect to time value of money, income, taxpayers want to defer income, and with respect to deductions, taxpayers want to accelerate deductions, because the idea with respect to time value of money is that $1 today is worth more than $1 in the future. So if you can deduct that money today and get that money back, it's going to be worth more than $1 that you could get in the future. Because if you're dealing with things like depreciation and recovery of capital, recovery of basis, then getting that amount today is better. It's saving you money today. You can invest, and that's the time value of money concept. So that is the fourth theme I want to mention. And these, the last theme I want to mention, the fifth theme, is disallowance. Disallowance and limits. So you're going to see in the videos that generally speaking, again, we have to start by categorizing the activity. Let's say we have a business activity. If you have a business activity, you determine that it's allowed to be deducted. That does not mean you can necessarily take the full amount, right off the beginning. No, you can't. You might be able, you very likely can, but you have to consider, what I'm saying is that you still consider other rules. It's not as simple as saying, okay, well, we have the deduction, or we determine that it's allowed, and that's it. No. You have to figure out the amount, and you have to consider the disallowance provisions and the limitation provisions. So, for example, losses. Losses might be allowed under the general rule, but then you might have other disallowance rules or other limitations, such as passive activity loss rules, such as the capital loss limitation rules, even related party limitations or wash sales. There's special rules you have to consider even though they're allowed. So the idea here is there's lots of interplay, lots of puzzle pieces that go into this. So I hope that this video, this general introduction to deductions, always come back to this, because if you consider these themes with respect to deductions, it will help you enormously whenever you're learning about deductions.